Hello everybody and welcome to today's presentation. My name is Chris Thomas. I'm a director of One Accounting. We are an accounting firm up in Edinburgh in Scotland, and we deal mainly with SMEs in Edinburgh and the Lothians across all sectors. Today's presentation is about a subject that I'm calling the entrepreneur's tax. George Osborne doesn't refer to it as this, but this was a bit of legislation that was introduced in his July 2015 budget, which is going to affect all owner-managed companies across the UK. We're going to be covering 5 main things today. We'll be looking at the changes in the tax rules on dividends which apply from the 6th of April 2016. We're going to be looking at year-end tax planning tips which you can maybe use before the 5th of April. Thirdly, we'll be examining different ways to pay yourself after the rule change on the 6th of April. We'll also be covering legitimate tax breaks that you can actually use in your business. And lastly, we'll be looking at perhaps using pension contributions as part of your overall remuneration strategy. So let's kick things off by looking at the background to the dividend tax. This is an extract from the 2015 budget that was issued. And perhaps if you could just look at the second paragraph there. What the aim here is to modernise dividend taxation and create a fairer system, level playing field. Now it refers to 1 million individuals paying less tax on their dividend income due to the dividend allowance, but conveniently the government are missing out at least the 750,000 owner-manager directors who currently pay themselves through dividends that are going to be paying more tax. So let's cover the main changes. So the rule change starts on the 6th of April, and it's going to hit SMEs across the UK. So it could be a family business, or it could be a one-man or one-woman band company where the owner or director pays themselves predominantly through dividends. There will be a small number of people that actually will pay less tax, but these individuals will generally be in employment and receive a small amount of dividends from shares that they own in PLCs. We'll run through some basic tax planning concepts which would apply to an owner-managed business. Now we would view national insurance as an avoidable tax. Obviously national insurance is something that's been with us for years. I think it was introduced just after the Second World War. But under the current rules, a director can avoid paying any national insurance at all by following the example on the screen here, where they pay a small base salary of £8,000 a year. The key thing is here is that they pay themselves enough to qualify for a year's worth of accrued state pension benefit, which is very important when you get to retirement age to make sure that you've got sufficient NI contributions. And then secondly, you would pay the balance in dividends, which have no national insurance and currently are tax-free if you earn less than £43,000 a year, which is where the current 40% tax threshold starts. Some people don't know what a dividend is, so technically it's a distribution of profits paid to a shareholder after the company has accounted for corporation tax. So you see an example on there on the screen, a very simple one where a company has profits of 50,000, it pays its corporation tax at 20% of 10,000, leaving profits of 40,000. So if this company had brought forward profits from the year before, 2014, of 15,000, they actually have profit and loss reserves of 55,000. So the 55,000 is the maximum dividend you can pay. So when looking at dividends, you need to look at the cumulative retained profits that you've made in your business from day one. So the current rules, they're quite generous. So a basic rate taxpayer will pay no additional income tax on dividend income. If you're a higher rate taxpayer, you pay tax equivalent to 25% of the net dividend. So if you pay a dividend of £10,000 to yourself and you're a higher rate taxpayer, you'll pay £2,500 of income tax on that dividend. And then if you're lucky enough to be an additional rate taxpayer, which is you earn more than £150,000, then your dividend tax rate on that top slice is just over 30%. And all tax is currently paid as income tax through your self-assessment tax return. So here's the new rules. Every individual will receive a tax-free allowance for dividends of 5k. So the first 5k of dividends are tax-free. Anything above this, well, basic rate taxpayers, you'll pay 7.5%. There's a typo there, sorry, the second one should say higher rate taxpayers, which is if you're a 40% taxpayer, your tax rate on dividends is 32.5%. and then if you're in the additional rate over above 150,000 of total income, you're going to pay tax at 38.1. So the key thing here to remember is that the bands are all being increased by 7.5%. And here's a table which specifies those in quite a neat form. The big question for any owner-managed business, any director, is, okay, I understand the new rules, how much more tax will I pay? Here's a table here. We're going to assume that the director is paying themselves tax and national insurance free salary of just over 8k and with a balance in dividends. So for example, if you pay net dividends of 30,000, then currently, if you look along the 2015-16 line on 30,000, you pay no tax on the dividends. However, for 16-17, you will pay 1,655 of income tax. So you can see there, if you're paying 30k of dividends, you've got a £1,600 tax rise. If you are a higher earner and say you've got dividends of 75,000 that you pay yourself, your tax bill for 15-16 would be about 11,000, and for 16-17, unfortunately, it's going up by 4,000 to 15,000. So you'll see from the table here there are some quite significant increases that might apply to you. So here's an example on screen, which again I've used the taxable profit figure of 50k. It works down to the tax that you would pay on paying a dividend of 40,000. So you'll see there that 27,000 of the dividend you'll pay tax at 7.5%. Sorry, just jump up one line. 5,000 of the dividend you'll pay at 0%. 27,000 you'll pay at 7.5%, and then 5,000 of the dividend you will pay at 32.5%. The rules are made slightly easier because the concept of a dividend tax credit is now being withdrawn with the new rules. So that was an adjustment that people often had to make. For example, they would be paying a dividend of, say, 10,000, which is the net dividend, but using the dividend tax credit rule, it was as if they paid themselves a gross dividend of 11,111, which is sometimes a bit difficult to calculate the tax that would be due. There's two ways you can pay the tax. For 16-17, for your self-assessment tax return, which this is for the year ending 5th of April 2017, the tax will be due at the end of January 2018, or HMRC might actually seek to change your tax code to collect the tax due at source through monthly pay-as-you-earn. We've yet to see any of these letters come through, but I know of other accountants that have seen them for their clients, and we can appeal this for our clients and request that method 1 is taken if those letters are issued. So you'll see there that the first payment of the dividend tax isn't due for quite a long time, more than a year and a half from now. So there will be some winners. This is where people are in receipt of dividends below 5k. There'd be no further tax, so you could see yourself as a winner. So it could be if you're just taking a small amount of dividends from your company, or if you have multiple shareholders just taking a small dividend of less than 5k each, they aren't going to be affected or hit by these new rules. Or if you have a share portfolio and a pay-as-you-earn salaried income. There will be losers. These are the SME business owners. So anyone running a business and paying dividends of more than 5k is going to pay more tax, unfortunately, in future years. So anyone paying themselves on or around the 43k level, just to stay below the 40% tax threshold, will have an extra £2,000 in income tax to pay. So let's run through some things that you might want to consider to minimise the effect of this dividend tax. So the key thing is to plan ahead and evaluate any dividend policy in advance of the 5th of April. So it's just coming up in a few weeks' time. One option is to accelerate payment of dividends before the end of this tax year. And this particularly is a good thing to do if you haven't used all of your basic rate tax band up. We'll cover an example in a minute. If you don't actually need the cash, the extra dividend, or if your company, if the bank account's maybe not as buoyant as you'd hope it would be, it is possible to pay a dividend and then loan this money back to the company. So it's just a movement of cash out of the company bank account and then back in again. So here's an example here that I'll run through. So this is a business owner that's paying themselves a salary of £8,060 a year, And in 2015-16, to date, they've paid 20,000 of net dividends. So that's grossed up by the dividend tax credit. That's where you see the 22,222. This individual had total gross income of 30,342. The 40% earnings limit for this tax year is 42,385. So we have headroom, which is a gap that they can utilise of just over £12,000. So what they can do before the 5th of April is pay a tax-free dividend, and it's the net amount we need to look at, of 10,839. So if this was my client, I probably want to allow a little bit more of a gap. So I'd say to them that they were perfectly safe by paying themselves a dividend of £10,000, and that's tax-free. So what actually happens with that, I'll just go back one, with that 10,000, you need to pay yourself the dividend and record it through with a dividend voucher and a board minute. But again, you can either keep that money yourself, or if you don't actually need that money, or you want to still have the company have the benefit of that, you can loan it back to the company, and this creates what's called a director's loan account. So that money is treated as tax paid. So on the balance sheet of your business is as if the company owed you £10,000, and the tax saving is that in future years, whether it's 16, 17, 17, 18, you've got £10,000 that you can take out of the company when the time is right, and there's no income tax to pay on that. So you're just future-proofing your withdrawal of money from your own business. So if you're a higher rate taxpayer, so you're earning over the 42,385 there, you can still use this mechanism. So you would pay dividends to yourself before the 5th of April, and what you're doing here, if you remember, you're avoiding the 7.5% tax. That's the key thing. If you pay after the 5th of April, and this is your normal income pattern, I'm afraid there's an extra 7.5% tax to pay. But remember that you'll have to pay this tax on the 31st of January 2017. So you're creating a tax liability in the 15-16 tax year. You pay that tax at the end of January. So you're paying it a year earlier than you would do if you delay. There's a cliff edge. In fact, there's more than one cliff edge that you need to think about. So this is where there's actually a jump in the tax rate, which might not be apparent to people. So from this coming tax year, the 40% tax threshold will be at 43,000. So that's the point that you jump into 40% tax. There's a couple more bands here that you might not know about. So if you have children and your total income from all sources, salary, dividends, rental profits, bank interest, is between 50,000 and 60,000, then you start to lose your child benefit. So it's possible you could be paying 58% tax on your earnings between these bands. And if you are fortunate enough to earn over 100k, or between 100 and 122,000 of income, your personal allowances starts to be clawed back, and you pay 60% tax between these two amounts. And then, as some as you may know, if you get above 150,000, then that top slice of income is payable at 45% tax. So you'll see there's some cliff edges there where just jumping up into the next tax bracket could actually cost you more than you think. We'll come to section 3. This is a question that we've been asked a lot by our clients. What is the best way to pay myself after the 6th of April? So we set out a few examples here. Example A, and we'll cover these in a bit more detail. Example A is just to continue as you are, pay yourself a small salary with a balance in dividends. The second one is, well, why don't we just pay a full salary subject to pay as you earn and national insurance? And the third one is quite drastic, but actually change your legal status from a limited company to a sole trader or partnership. So here's an example for a company that currently has profits of 58,000. So what I've set here is the profit using options A, B, and C. So the profit using salary and dividends, the profits that you might have where you pay everything of salary with the exception of a 5k dividend, or if you revert to a sole trader, and I've specified the total tax that you would pay. So you'll see in ascending order, the lowest tax option is still the current one. This is where you pay the 8k salary with a balance in dividends. You would pay £13,650 in tax, and this is a combination of corporation tax and income tax. The second best option is to actually change your legal status to a sole trader. So you'd see there that you'd, on the same level of profits, 58k, you would pay about £2,000 more in tax and national insurance, so 15,640. Of course, sole traders don't pay corporation tax, so that amount is income tax and national insurance that sole traders pay on their profits. And then lastly, the most tax option, if you want to go for that, I don't know why anybody would be to pay a high salary to yourself, so pay almost all the profits of the company out of salary, and then leave a balance of 5k after corporation tax to pay as dividend. So here we're paying total tax of 17,912, and that is complicated because it's a combination of corporation tax, income tax, and national insurance, both for the employee and employer. So judging the salary and dividends, that's by far the best route by a few £1,000s. There's an example here, second example, using profits of 35,000. Again, the salary and dividends route is the best one, but you'll notice if you look at the figure at the bottom there, sole trader, the sole trader is paying a small amount more, only about £500 more in tax than the limited company. So what we're expecting is, certainly for startups, is that they would need to consider in more detail whether it would be better for them to start their business as a sole trader. It's true to say that limited companies do have higher compliance costs. For example, generally the accounting fees are higher. You need to submit an annual return to Companies House, and also your accounts go on the public domain. So there's some things that people need to consider when choosing a legal structure. So in summary for that section, pay-as-you-earn salary means that you would pay the highest amount of tax and national insurance, but that the tax gap between a limited company and a sole trade, particularly for a startup, is now very small. If you've got benefits in kind running through your company, for example, a company car, or you have healthcare benefits, gym memberships, don't forget that as an employee of your company, you're paying a substantial amount of income tax on these benefits. If you were to revert to a sole trader or a partnership, you're no longer an employee, you are the business owner effectively, and you don't have the benefit in kind tax. So it could be, if you've got particular circumstances where you've got modest profits but you're driving a company car and are paying quite a lot of tax on that, it could actually be better for you to revert back to a sole trade or potentially a partnership if there's two or more of you. Okay, we're just going to run through some tax breaks that owner-managers can use in their business. At the moment, if you have a spouse or a partner and they're currently not working, but you want them to work in your business, you can employ them and you can pay them, well, firstly, you can pay them £8,000 a year with no tax and no national insurance. Or secondly, if you wanted to go up to the point at which income tax starts, pay them £11,000, so there'll be a small amount of national insurance to pay on that. And there's a saving there because your partner or spouse would receive obviously the salary with more or less no tax or NLC paid, and also you get a corporation tax saving as well. So it's important that they are actually employed by the business, but we've seen people use this method where they need help with their bookkeeping, or they need somebody to help manage their diary, make phone calls, set up meetings, and do other administration tasks for the business. Second option, it's a bit more complex, should we say, but if you are married, you can gift shares to your spouse. This only applies for married couples because the transfer of assets, of which shares are an example, can be done between husband and wife tax-free. So there's a few things to consider here. Well, if your spouse, your husband or wife was a shareholder in your business, then they could receive 5k of dividends tax-free. And for higher earners, it's possible to utilise the spouse's unused 20% tax band, but the tax warning on that is that the government and the Treasury do look quite closely at what they call income shifting, which is where you have income moving from a high earner to a lower earner through the form of paying dividends to the low earner, but we can provide more advice on that. And also importantly, remember that your spouse now owns a percentage of your company. Some people are comfortable with that and others aren't, but it's important for you to remember that. Thirdly, this is a good thing that the government have done. If you employ staff, you can claim the employment allowance. So if you're one accounting client I'm pleased to say that we automatically claim this on your behalf. It means that as of April 2016, you can, the first £3,000 of employers' national insurance will be effectively rebated. You don't need to pay it. The current amount is £2,000 for this tax year, so it's going up by £1,000 to £3,000, which is great news. If you work from home in your business, if you run a consultancy or something and you work at home full-time on your business, then you can claim the £4 a week use of home allowance. If you only work a smaller number of hours in the business, you can still claim an amount, but it's less than £4 a week. If you have children, you can set up a childcare voucher scheme so that you can claim tax and national insurance relief on your childcare costs. We've got a number of clients that are doing this, and we work with a really good agency called Gemelli that handle all of the childcare voucher scheme and payments to childcare providers, whether that's a nursery or a nanny. They deliver a really good service for our clients. However, that obviously applies to only people who have A, children, and B, they actually have paid for childcare costs. So if you've got a relative that looks after your children after school, I'm afraid that doesn't count. A new thing that's being introduced on the 6th of April is that the first £1,000 of interest income that an individual receives is tax-free. So before, there's currently tax that is due on interest. So it would be possible, if you remember back from a few slides ago, I suggested loaning money to your company if you didn't actually need the dividend yourself. Well, if that was you, you could actually charge your company interest. So say, for example, you'd loaned your company £10,000. You can charge interest at, what would a market rate if you were to go out and borrow money? Say 5%. You could charge the company 5% interest on your loan. So on the £10,000 loan, at 5%, that would be £500 a year interest-free that your company could pay you. And there's also a benefit because the company can claim a corporation tax deduction on the interest that it's paid you. So this can be quite a tax-efficient method if you have loaned money to your business. Okay, option G here, I still see people that don't do this, but just a reminder that if you use your own car for work, whether it's a trip to see your accountant or a prospect, a bank manager or a customer, remember to keep a mileage log and you can claim 45p a mile for all business journeys up to the first 10,000 miles. After that it's 25p a mile, and if you're healthy and you ride a bike to do these journeys, then you can claim 20p a mile for those. Lastly, we've got technology companies or maybe manufacturing companies who could be eligible for R&D tax credits, which is a fantastic way to reduce your corporation tax bill. So we've actually had clients in the IT sector and the graphic and web design sector that are successfully claiming R&D tax credits for their business. So if that's you, then by all means get in touch and we can talk through your options in more detail. But this is a great tax concession that the government have had in place for a number of years to encourage businesses to innovate and research and develop new products. Okay, the last section for today is just to look at pension contributions as part of your overall remuneration. So here's a scary snapshot. I took this from the paper earlier on in March. There's currently a review that the government are undertaking into old age pensions. The facts are by 2050, there are going to be less people of working age than there are pensioners. So for every 2 people working, there will be 3 pensioners that need supporting. So if you do the maths, then you can probably tell that the government won't have enough money to pay all us pensioners when we get to that age. So one thing they're looking at is raising the state retirement age yet again. For myself, I won't tell you how old I am, but my retirement age is 67, so I've got a few years to go. But if you're a bit younger, then potentially you could be working well into your 70s. So it's a fair thing to say that you need to consider your pension options even if you're still only in your early 20s. So if you run your own company, the company can make pension contributions directly into your pension fund. What we have clients doing is either making a monthly payment into their own pension fund, or if they've had a good trading year and they want to reduce corporation tax, they make a lump sum payment just before the year end, goes into the pension, locks away for when they retire, and the company is claiming corporation tax corporation tax deduction as well. This actually applies for sole traders as well. In fact, all small companies in the UK would need to consider auto-enrolment, which is the compulsory state pensions. We've got a number of clients going through this at the moment, and that's going to be in place for all companies by the end of 2018 or 2019. If you are running your own company and it's just you, or you only employ, say, your spouse, then you can opt out of auto-enrolment. But if you have a trading company, and even if you just have one part-timer, then you will need to have an approved auto-enrolment pension scheme in place. So the advantages for pensions, well, you can claim a corporation tax deduction. At the moment, if your business is doing well, you can pay up to £40,000 a year contribution, and you can actually use a thing called carryback allowance, so you could pay as much as £180,000 into your pension, but that's obviously only a small number of people. But we can advise on that to see if we can work out what your maximum limit pension contributions would be. The big advantage at the moment is that there's no national insurance on pension contributions, either for the employer, as the business, or you as the employee. So there's a definite NIC advantage there. And you can withdraw 25% of your pension pot tax-free at age 55. So we've actually got clients that are in their late 40s, early 50s, just trying to put as much money as they possibly can into pension, with a view to withdrawing the lump sum at age 55 and potentially paying off their mortgage or investing in, say, a buy-to-let property and actually making that tax-free money work for them in a better way. Okay, a few things coming up. Okay, so the budget, well, this has actually happened. So the good thing is here that there's been no restrictions on pension contribution tax relief. The proposed merger of income tax and NIC is still on the table, but nothing's been announced in terms of the implementation of that. It's likely to be after the next election, which will be in 2020. There is a reduction in corporation tax coming up. So the budget announced that in April 2020, the rate actually falls to 17%, which is a good thing. And there's a drop to 19% in April next year. There's a Scottish election in May 2016, which is just a few weeks away now. And the current Scottish government have announced that the planned increase in the 40% tax threshold, which was announced by George Osborne in his budget last week. So the plan is from April 2017, if you're an English taxpayer, your tax-free personal allowance will rise from £43,000 to £45,000. Sorry, not tax-free. Your 40% tax threshold goes up from 43 to 45k. However, in Scotland, it's only going up by the rate of inflation. So I think it's only going up about £300. So from April 2017, if the current Scottish government remains the same, then if you're a higher earner in Scotland, you will pay more tax. And lastly, there's the Euro referendum vote, which is coming up in June. Will we stay in the EU or will we leave? And what would be the consequences of both? We'll have to wait and find out. So let's just conclude things now. Remember that the new dividend tax rules apply from the 6th of April this year. If you pay yourself dividends, then the tax due will be disclosed on a self-assessment tax return, and the first payment of this tax will be due in January 2018. So if you're a one accounting client, we're going to be working with you, and you will be prepared. You will know the amount of tax that's going to be due a long time in advance of January 18. And lastly, just think about paying yourself more dividends before the 5th of April to save yourself 7.5% in tax. So lastly, we're here to help and advise. Contact myself, Chris Thomas, or my co-director Neil for an individual assessment, and we can look at the best options for you. Thanks very much for watching, and we'll speak to you soon. Bye for now.